Good evening, ladies and gentlemen. Good to see all of you here tonight, and welcome to Talk to the Tax Man, where we're going to learn everything we ever needed to know about taxes from an expert, Peter Newman. I'm Emily Fowler. I'm the Polsky Series Director, and again, thank you for joining us here tonight. Before we get started, I would like to ask that you turn off cell phones, pagers, Blackberries, all those electronic devices that make noise so that we can enjoy the program together. Thank you. The Polsky Practical Personal Enrichment Series is underwritten by the Norman and Elaine Polsky Family Supporting Foundation within the Greater Kansas City Community Foundation in partnership with Johnson County Community College. It includes topics which are not being offered anywhere else, where successful professionals share their knowledge to benefit you. Norman and Elaine's name graces this beautiful Polsky theater, where a variety of events are held throughout the year, and we thank them for their generosity, which allows the Polsky Series, among other well-deserving organizations across Kansas City and the nation, to serve their communities. Norman and Elaine, thank you very much. I'd like to take a quick moment to acknowledge Mundy and Yazdi Oriental Rugs for the lovely rug on stage tonight, and also our wonderful TV and Carlson Center production crews. And now for the packet that you all received when you came in. This is for you to take home and to share with your family, so let me take you through the contents very quickly. On the right-hand side, an overview of the material that Peter will cover tonight is on the blue sheets. And behind that is a yellow handout that deals with Medicare premiums and other senior adult information. On the left-hand side, we have two cards. First is the blue question and answer card. During the program, if you have a question for our speaker, please write it on the card. We'll ask you to pass it to an aisle, and the ushers will come by and pick these up from you. That allows us to get to more questions during the program than in other ways. Also, there is a green survey card. Please fill this out and leave it with us before you leave tonight. We want to know what you think of our series. Give us feedback so we can improve from one time to the next. And on the other side, you can add yourself to the mailing list if you're not already receiving our information, or if you'd like to suggest topics for future seminars. We'd love to have your input on that as well. Norman wants me to tell you we need 100% of these back, so please don't forget to leave this with the usher before you leave. 100%. He'll call me tomorrow and ask me, so thank you. Also on the left-hand side, the Polsky Practical Personal Enrichment Series future seminars for 2007. You can see what's coming up as we move through the year. A pink sheet that gives you information on Moneyline, Peter Newman's program that's broadcast on KMBC 980 a.m. every Saturday morning. And then the last two on that side are information from Norman. The first is his quarterly report of results from his mutual fund investing. And as I pull that out, there is a vertical side and there is a horizontal side. If you'd like to receive this quarterly report from Norman, please send 4 self-addressed stamped envelopes to his address. It's at the top of this sheet, and he'll be happy to send it out to you. He wants me to tell you he spends 1 day every quarter processing this mailing, and he would like to share this information with you if you're interested in receiving it. Also on that side is Norman's My Legacy to You, 4 Principles to Achieve Financial Independence. This is based on some information in Jim Stour's book, Yes, You Can Achieve Financial Independence. That's for sale in our lobby this evening. This is Norman's take on that information, and then some other additional things he's learned about investing over the years since he's been in mutual funds. So that is something you'll want to read when you get home tonight. You'll notice that tonight's program is being taped for broadcast on JCCC TV, which can be found on Time Warner Channel 17 or Comcast Channel 22. And this is a new development. Links to Polsky Series broadcasts can also be found on the JCCC website. So if you have a connection to the internet, you can log on to video.jccc.edu, and you can watch these seminars anytime you want. So when you can't sleep, 2 in the morning, it's there for you. And now, ladies and gentlemen, it's my pleasure to introduce our speakers for tonight's session. Peter Newman has over 30 years' experience in financial planning and tax preparation. He is a veritable encyclopedia of financial resources. Born in Vienna, Austria, Peter came to the United States in 1944. He graduated from UMKC with distinction in his field of accounting, finance, and taxation, and started his career with one of the Big 8 CPA firms. Peter has his own firm today, Peter Newman CPA Chartered, which is located in the Windmill Village Office Park in Overland Park, Kansas. And 2007 marks Peter's 21st year as host of Kansas City's most listened to financial program, Moneyline, heard every Saturday morning at 11 a.m. on KMBZ. His program covers every aspect of financial matters: taxes, investments, insurance, retirement planning, real estate, you name it. He's had guests like Steve Forbes, Knight Kiplinger, the IRS Commissioner, the President of the American Stock Exchange, representatives from every major mutual fund. They've all been on Peter's show, so we hope you can tune in and listen. Peter does 20 to 30 seminars each year for churches, civic, and business organizations, including lectures for numerous brokerage, mutual fund firms, and banks. And he has accredited real estate courses also and has lectured to 5 National Association of Realtors annual meetings from Miami to Honolulu. So please join me tonight in welcoming Peter Newman.
Thank you very much, Emily. I assume everybody can hear me all right, hopefully. First of all, I want to tell you that tonight we're going to talk about a lot of aspects of money. First of all, we'll talk about the wonderful world of money and the not-so-wonderful world of income taxes. But before I do that, I want to take out a couple of seconds to give thanks to a couple of very important people. Number one, Elaine and Norman Polsky, who really, unless you know them as well as I do, and Bev and I have known them for a lot of years, are one of a kind. There's no question about it. Not only the Johnson Countian of the Year, which is rightfully deserved, but people who have spent time, money, and effort in an attempt to educate everyone about this complicated world that we live in today. So Norman and Elaine, thank you again, and we really appreciate all of your support that you've given us as a community and as individuals. And then I want to thank Emily Fowler and her staff for helping, and really helping in a very unusual way. Last Tuesday, as you'll recall, we had a pretty good snowstorm. Do you remember that morning? It was yucky outside. In fact, I was supposed to be at a seminar I couldn't even go to. It was so bad. So I called Emily and her staff and I said, do me a favor. Would you please pray? I said, you probably have closer connections to the Lord than I do. Would you please help me and pray? And look what she accomplished. I mean, after all, and so from now on, when I want any contact with the Lord, I'm calling her and her staff first. But having said that, I said earlier that one of the things, of course, that Elaine and Norman try to do is to try to help people understand this complicated world of financial affairs. And it is definitely complicated. And it keeps getting worse and worse and worse. And of course, all of you hopefully have attempted to do some investing. You may have hired a broker. And if you've hired a broker, you've probably had, if you're 50 years of age, you probably had 10 over the years of your life. And you know it's not an easy task. But the one thing that's really critically important is that you learn, that you become educated. Now, you know my philosophy has always been that one of the reasons that so many of us perhaps are not educated is not necessarily your own fault. Certainly it's in part your own fault, but the blame in part goes to the educational system that we have. How many people do you know who, for example, are in engineering or doctors or lawyers or others, who ever were trained on anything about financial affairs? I mean, if I were to ask for a show of hands how many of you had some education in that regard, I'd venture to say 99% of you would say, I learned nothing. What did you learn? You learned Spanish, you learned history, you learned trigonometry. All of those things you learned, 90% of which you don't ever use, but you never really got a good education in the one thing, unfortunately, that we all need education on and training on, and that's money. And so in an attempt to try to educate people, over 21 years I've done my program, and you hopefully have attended seminars like this to learn something. Now, we know that making money is obviously important for all of our lives, and we as Americans are the worst when it comes to saving. In fact, if you looked at the statistics, in the last quarter, we had a negative savings rate. And you know, you don't realize how important that becomes until you become a senior citizen. And you look and say to yourself, well, what did I do over my lifetime to try to get money so that I have something to retire on? And most of us are wonderful spenders, but not such good savers. And the other thing that we're not good at, unfortunately, is learning something and understanding about these tax laws. When you figure that roughly 30 to 40% of all of your money, in some cases 50%, goes for taxes, understanding something is very important. In fact, I just left the office about an hour ago, and I'm telling you the honest-to-God truth. There was a couple in the office next to me with one of my people, and they were asking a lot of questions. And they were great questions. I could tell by listening to this person that this person had a good understanding of not only financial matters, but tax matters. And she was very inquisitive about trying to find out why this or why that, or why did the tax law affect her in this way. And that's how you get bottom line benefit when you are educated. It's never too late to start. You know, education is an ongoing thing. In fact, I've been in this business 45 years, and every day, and this is, I'm telling you the truth, I learned something that I didn't know before. And nobody knows, of course, everything when it comes to tax laws. And probably the least, does anybody here work for the IRS? Probably the least the IRS. But it's not their fault. Let me stress that. The IRS has an unbelievably tough job. Very tough. In fact, I admire the people who work for the IRS because every time there's another change, and they can't keep up with it, it's impossible to do. They have a tough job to do, and the bottom line is they wouldn't have to do this if we could just get Congress to finally wake up to the real world of the stupidity of this god-awful tax law that we deal with every day. It's stupid, it's ridiculous, it doesn't work. We spend $255 billion a year trying to comply with the law. I'm not going to go into a lecture of what I think is the right way to do. I don't know that it'll ever change, but I'll tell you one of the reasons I think it'll never change. Most individuals who pay income taxes are working individuals. Every week or every month or every 2 weeks, they have money withheld from their checks. And although they realize it's being withheld, at the end of the year, what happens? 75% of all taxpayers actually get refunds. $5,000, $6,000, $8,000, $9,000. Leaving that with Uncle Sam and earning all that interest, which is nothing, of course, zero, it doesn't make sense. Americans overpay their taxes in most cases because they're so nervous about having, in fact, to pay a penalty. And that is a thing that should not occur. It's ridiculous to pay in all this money. And the tax laws, of course, are always changing. For example, if you look at the 1913 income tax return, in fact, there's a copy of it here. Let me tell you here what exhibit it is, because I want you to look at it for just a minute with me. If you take this yellow pass-out materials that I gave you, look at Exhibit C for me for just a moment. Look at Exhibit C. That is the first income tax return. Look at it a minute. One pager. And now remember, this is 1913 that we're dealing with. Look at that line down there, number 1, down there at the bottom. 1% on amounts over $20,000. 1913. How many people do you think made $20,000 in 1913? Maybe Norman, but not the rest of us, that's for sure. Is that right, Norm? Because generally speaking, probably somebody who's doing pretty good in his lifetime, and thank the Lord we have people like Norman and others, they might have fallen into this bracket. But I doubt even Norman did. And that's how this whole thing was sold to the American public. We operated this nation for 137 years without any income taxes except for a short stint that took place during the Civil War. And then we got the 16th Amendment, the worst amendment ever enacted into our Constitution, the right to tax income. And ever since then, you've been locked up. And you're trying to figure out ways to reduce the tax. And by the way, look at that top bracket down there. 6% on anything over $500,000. 4 years later, after this was done, the top bracket was 24%. So it didn't take long for Congress to change. Now, every year we constantly get tax law changes. It used to be, when I first started out, we worked under the 1954 Internal Revenue Code. Hardly ever was there any major change. In the last 2 years, we have had 7 tax bills, each one more ridiculous than the other. We're going to cover some of those tax bills so you understand what they're all about, at least get the overview of what they're all about. So this is the ongoing saga of what goes on. Do you remember about 2 or 3 years ago when I was doing this seminar, I was mentioning that Uncle George, Uncle Bush, was actually doing something to maybe change all this. He appointed a 9-member committee. They made a detailed analysis of what they should do to change the Internal Revenue Code. What ended up happening? Nothing. Did we expect anything else? Of course not. We knew nothing was going to happen. But yet he spent the effort to do it. At least he tried, let's put it that way. But one of the reasons nothing gets changed is because you don't make the change makeable and doable. And the reason for that is, as I was saying earlier, most people have income taxes withheld from their salary. It bothers them, but they're not writing a check. They don't physically write the check. And so we don't get enough complainers. If we would just get complainers to get up and holler and scream, and it can't just be Peter Newman, because I do it all the time. If you've listened to my program, you've heard me say time and time again, we've got to do something. Something has to change. We've got to stop wasting our money, our time, our efforts, and make them constructive, make our workload correct and produce something. But we can't get it done. Because either everybody's saying, I'm going to leave it up to Pete Newman to do it, or you just leave it alone. So the bottom line is we're going to have to put up with this, and I'd use another word except I'm in an audience where there's a lot of women, but we do something to get some changes made, and you can't leave it up to somebody else to do. In fact, can I tell you something? Even the Internal Revenue Commissioners, who are no longer commissioners, and I think specifically of one, Shirley Peterson, the only woman commissioner that we ever had and probably the best, after she left, she said, this taxation system is stupid. That's what she literally said in plain, simple English. It needs to be changed. It needs to be revised. Ask anybody who doesn't work for the Internal Revenue Service anymore. While they're working, they better not say that, but they will say it when they've left. And can I tell you another thing that you might be amazed at, or maybe not amazed? The GAO, the Government Accounting Office, has for the last 5 years come back and said they cannot validate the validity of the IRS's records. Surprising? Absolutely not. It's too complicated. And it's not, again, it's not their fault. It lies on the face of only one group of people. And who is that? The congressmen and women that you send to Washington. That's where the fault becomes. That's what created these 7 tax laws, none of them which makes a lot of sense. So let's talk for just a minute about some of these changes that have occurred here in the last 2 years. One of the first bills that got enacted was the energy bill. Now, the energy bill itself was very good if you had a couple of oil wells in your backyard. But for those of you who didn't, it wasn't a particularly great bill, but I do want to reiterate some of those things that might apply. For example, if in the year 06 or 07 you do anything like put insulation in your home, you put on some new storm windows, you put on a storm door, you get a new air conditioning system with at least a SEER of 15 or better, you're entitled to get a federal tax credit, and we're seeing a lot of those, by the way, coming through right now, up to a maximum of $500. So what you need to do is, if you did anything like that, you need to go back to Lowe's or wherever it was that you bought your windows or doors, get a manufacturer's certification statement, take it to your preparer, and for those of you who have already done your returns, check it out with them again, and get that certification statement. It'll benefit you to the extent of $200 to $500. How about those great cars that we get now, the energy-efficient cars? Anybody here bought one of those energy-efficient cars? I bet you have. There's as much as a $3,200 federal tax credit that's available. However, you know, Congress doesn't make these things simple. The maximum number of cars that a manufacturer can manufacture is 60,000 cars that are eligible for this credit. Once they've reached that maximum production, then the credit decreases, and at the end of roughly 6 quarters, there is no credit. You're going to find something else interesting, and we'll talk more about this. Anybody familiar or ever got faced with this beautiful alternate tax called the alternate minimum tax? Can I kind of see a raise of hands? Anybody got? Yes, absolutely. When I asked the same question about 6 years ago, you know how many show of hands I had? 1. Now the AMT tax, the alternate minimum tax, is hitting about 1/3 of all taxpayers. What an unfair tax. If they don't get you one way, they're going to get you another way. They're not happy. You know, I write the Internal Revenue Code, and the bottom line to the Internal Revenue Code is there's a taxation system. Whether you like it or not, you have to live with it. And so about 25 years ago, it was decided by Congress that, gee, some individuals were making too much use of certain aspects of the code and reducing their tax. Now that ain't fair, is it? To reduce your tax by too much. That's not the way it should be. So we enacted a brand new alternate minimum tax. And that means that certain deductions aren't allowed. I'm not going to go through the whole spiel with you because it ain't worth the time. But the bottom line is, if you don't get it one way, you're going to get it another way. And that's not right. That isn't the way it should be. But if you buy one of these energy-efficient cars, and if you're faced with the alternate minimum tax, you get absolutely no credit. Because under the alternate minimum tax, these credits are not allowable. Now, that's basically the essence of the major part of this particular energy bill. Now, let's talk about some of the other bills. We had another interesting bill that came out, the Pension Protection Act. By the way, watch as I give you the name of these acts. They're running out of names to name these acts. You'll see some real funny ones coming up here in just a few minutes. There's some interesting things about that Pension Protection Act. First of all, probably one of the most interesting things was, and I'm sure some of you maybe have already availed yourself of it, is that if you get a distribution, whether it be a required minimum distribution or not, out of your retirement accounts, you can take that money, up to $100,000 per person as long as they're over the age of 70 and a half. Why couldn't they just have made it 70? What's the deal here? You know, I mean, why does it have to be the half? Can't it just be a simple, easy number to understand? 70. But in any case, that's the way the government is. So if you want to take, and you're over 70 and a half, up to $100,000 out of an IRA, if you take money out of an IRA, what generally happens to it? Doesn't it get taxed? Sure it does. But what you can do is you can take that $100,000 and have it sent directly to a charitable organization. If that gets done, then there is no taxable income to the taxpayer, and conversely, they don't get a deduction either. And most people would say, well, then what's the reason for doing it? I mean, under the other way, I'd pay tax on $100,000, I'd get a deduction. Doesn't that equal out? 100 in, 100 out? Isn't that zero? Of course not. not when you're dealing with the Internal Revenue Code. And why is that? Because whatever income you have, we refer to that as the adjusted gross income, it causes certain things to happen. The higher you go, the more deductions you lose, the less exemptions you get to take, the higher the amount of Social Security that can be taxed. And the bottom line is it's very efficient. It's the right way to do. If you're going to want to make a contribution to a charity, the better way to do it, if you're going to even have to take minimum distributions, just have it sent direct. It can't touch your hands. It has to be done directly. And that's the way it should be done. And and by the way, how long is this good for in the Internal Revenue Code? How many years? 2. That's all. 2. Why not leave it in? What is this with these constant limitations? Only so much a year, only so much of this. Why does it have to be this complicated? What is the stupidity in Congress that makes them say every bill has to be more complicated than the next? It doesn't have to be, it shouldn't be, but that's the way it is. And that's what bothers me. You know, my livelihood, believe it or not, almost, is taxation. And I'm probably the only one out there whose livelihood is taxation, who is very critical of the tax law. You know, as Emily Fowler told you, I was born in Vienna, Austria. I was very lucky, very fortunate to come to this country. You know, I came with nothing. Thank the Lord, He was very, very good to me. And I have a lot of people to thank. I'm not going to tell you who all, but a lot of people to thank that I'm even here in this country. And I love this country, probably more than 99% of you do. Because I've seen how the other people in this world live. I live there myself. And I love this country more than anybody can possibly imagine. For the opportunity it gave me, for the freedom it gave me, for all the good things in life that it gave to me. I could be dead. But the one thing that bothers me is, why can't we make it even better than it is? And we can make it better by changing this taxation system that we have. But as we're talking, though, about this Pension Act, let me tell you a few other things that's in here. I'm assuming that all of you are fairly charitable. That's pretty common of Americans as a whole. And there's been some changes in that bill with respect to donations. You know, I frequently get clients who come to my office and say, well, Mr. Newman, you know, I went to church, or I went to the synagogue, or I went to the Buddhist temple, wherever they happen to go, and I threw X dollars into the kitty every week. And so that amounted to maybe $3 a week, so I got $150 of deduction. No more. You cannot get a deduction any longer unless you have proof, meaning a check or a confirmation from the charity, that you did in fact make a contribution. So don't try to take a deduction for things that you gave to somebody who came up to your home and you gave it to. If you had a receipt, that's fine. If not, no good at all. You're not going to get that. And by the way, the law is still in effect that took place about 5 years ago. You must have in your possession a confirmation from the charity on any single payment that you made of $250 or more. You don't have that, even the check itself will not substantiate the deduction if it's more than $250. How many of you here give clothing and household goods away? Everybody does. And how many of you use that booklet that we tell you to use? Hopefully you're using it. Changing the law there. If you give clothing and household goods away to a charity, it can no longer be in fair condition. It can no longer be in poor condition. It must be in good condition or better. Anybody give a car lately to a charity? You're not doing as much of that anymore. And why is that? The law changed. Used to be that a person would give a car to a charity. And how would they take the deduction? They'd go to the internet. They'd find out what the value of the car was according to the internet. Or they'd call their dealer. That's the deduction they took. No more. You get absolutely no deduction unless you get from the charity a 1098-C, which stands for car, that tells you how much they sold the car for. If you don't have that, you get no deduction whatsoever. None. And that's why more and more charities are not getting cars anymore. Now, the only reason it would be different would be you still need a 1098-C. If the charity kept it for their own purposes, they still have to confirm to you what, in their eyes, the value of that vehicle is. So don't try to take a deduction for an automobile unless you have a 1098-C. Anybody familiar with 529 plans? We're going to talk more about these 529 plans, but in that pension plan, believe it or not, the 529 plans are now permanently in the code. They were scheduled to expire in the year 2010. They are now permanent. And we'll talk, by the way, about that. And I understand, by the way, this seminar is scheduled for 3 hours. Is that right, Emily? I believe that's, Emily told me that. I hope she didn't tell me a lie. But we'll talk about that. Let's talk about a couple of other interesting things that happened. Oh, by the way, refunds. I told you that about 75% of all taxpayers get refunds. This year you have an option. First of all, I hope you're all e-filing. That's the first thing. Don't file a return unless you e-file the return. It doesn't make sense to do it any other way. For example, I just had somebody who came in today, signed the document. They'll get their refund a week from this Friday. That's how quick it is. A week from this Friday, they'll get their refund. But you have an option now. You got a refund coming? Let's say you're in the middle of a divorce, God forbid. You want half the refund, your wife wants half the refund. You can split the refund. You want the refund to go to a broker for an IRA? You can even do your IRA that way. I don't recommend it, but you can do it. So splitting it is very, very doable now, and all you have to do is tell your preparer how you want that refund to be split, and he can do that for you. Okay, let's talk a little bit about a couple of other things in this bill. It used to be under the old law that I could say, for example, leave an IRA to my wife, and she could, upon my demise, put it into her name. That was the only case that an individual, a beneficiary, could put it into their own name. Starting in 2007, it's not just the spouse. Anybody who inherits an IRA can, in fact, transfer it into their own name. It's doable now. It didn't used to be doable. So that's a nice change in the law. And by the way, in the year 2008, in this particular bill, another change. For those of you who are familiar with IRAs, and you have previously transferred to a Roth IRA, and we're going to talk a lot about Roths in just a minute, under the old law, you first had to go from a retirement account to an IRA, and then from an IRA to a Roth. Hallelujah. Change in 2008. You can go directly from your retirement accounts to a Roth without any problem. And while I'm on the subject of Roth, let me tell you something else that's very interesting. And by the way, when you leave this evening, there's going to be a pass out to all of you. Should you or should you not convert from an IRA, a regular IRA, to a Roth, and when does it make sense to do it? But in the year 2010, a new event takes place with respect to IRAs and Roths. Right now, if you want to take an IRA and convert it to a Roth, your adjusted gross income must be under $100,000. And of course, when you do it, what happens? You pay tax on it. In the year 2010, here's the change. You do not have to have any adjusted gross income, or you can have all the adjusted gross income you want. You can have $1 million in adjusted gross income, and you can still do the conversion. And listen to this additional benefit. You pay the tax over a 2-year period. So I convert my IRA in 2010, and I made $1 million. The Lord should will it. But if I made that kind of money in the year 2010, I can take my IRA, I can convert it to a Roth. I do not pay any tax until 2011. And in that year, I pay half the tax. In the year 2012, I pay the other half. So for those of you for example, that are in qualified plans and have limitations on your IRAs, go ahead and do now a non-deductible IRA and then convert it in the year 2011 or 2010 if you wish. So those are things, again, that this particular bill really did and did well in accomplishing some good benefits. There's a bunch of other things. I'm not going to go through them. I want to switch just a minute now to TIPRA. What does TIPRA stand for? The Tax Increase Protection Reconciliation Act. Remember I told you, they're getting some real fancy names. The Taxation Increase Protection Reconciliation Act. What other names are they going to dream of? But there's some interesting things that took place in there. You know, it used to be that if you had kids and you wanted to get rid of some of your income, you'd transfer some assets to your kids. The kids would earn the income, and they generally paid little or no tax. They were human beings, in other words. About 7 years ago, children under the age of 14 ceased to be human beings under the Internal Revenue Code. Why was that? Because the law said that if your kids were under the age of 14, and the current law is, and made more than roughly $1,600 of unearned income, you paid at the parent's highest tax bracket. You know, the idea was, hey, don't try to get out of paying taxes. You can't use your kids. No way. See? So what they did was they, in effect, converted it and said under the age of 14. Well, remember now, this is a Tax Increase Protection Reconciliation Act. What's the first thing in it? Get more money. It's not protection. Get more. What they do, they increase the age to 18. Anybody under the age of 18. So this year, in the year 06, by the way, this applies to, not 07, 06 is when it starts. If you have children under the age of 18 and their unearned income, and I'm talking about interest, dividends, not salary, exceeds $1,700, the first $850 is free, the next $850 is taxed at their regular rates, 10 or 15%, $1,700 and over, and say the parent is in the 28% bracket, anything over that, 28%. Unbelievable. I just can't fathom how this Congress comes up with all these things that make it more difficult and harder to understand. So that's part of that particular bill. Now, the other thing that's in there and that's very interesting is that the capital gains rates, and I'm going to spend some time talking about capital gains, but the capital gain has some interesting twists to it starting next year. For individuals who are either in the 10 or 15% bracket, if they have capital gains, and do you know what I'm talking about when I say capital gain, or do I need to define that for you all? Capital gain is if you sell, for example, a stock or any other capital asset, you held it for a year or more, you create what's called a capital gain. Hopefully it's a gain, not a loss. And you pay a capital gains rates. Most individuals are going to pay a maximum tax of 15%. However, in 2008, zero. No tax on capital gains if, and remember the scenario here, if the top bracket that you're in is 10 or 15%. So it's not for everybody, but at least it's a doable situation that you need to be aware of when it comes to capital gains. Oh, another wonderful thing in this TIPRA bill is an interesting deduction that's available for individuals who are buying a home for the first time in the year 2007. Normally, private mortgage insurance, PMI, is not deductible. But starting this year, if you get a new home, or any home, can be an old home, but a new home to you, and if you have private mortgage insurance on that loan, you get to deduct the interest for how, or the insurance. For how long is it? 1 year. But wait a minute, we're not through yet. That's not the only thing in this. Your adjusted gross income cannot exceed $100,000. What in the world did they enact this stupid thing for? They've probably spent $3 billion determining how much, what percent, who qualifies, who doesn't qualify. The whole thing is worthless. Probably nobody's going to use it, but here it is, sitting in this tipper bill for what I don't know. I mean, just a waste of time, paper, but that's the new law. So that's the major aspects of what's in that tipper bill. Now let's talk about the most recent bill. When was it enacted? December the 8th. And by the way, what I'm going to tell you now is very interesting. Why it is that Congress enacts these laws in November and December is unbeknownst to mankind. Because the tax forms had already been mailed. Everything had already been sent. They couldn't change the tax forms to comply with these new laws. But let's talk about what they are for just a minute. First of all, there were several things that were scheduled to expire, and this particular extender bill extended it. Number one, especially because we're in an educational institution. Under the old law, teachers, educators, principals, librarians, anybody that taught, that was a teacher, could deduct on the front of the tax return, not in the itemized section part, up to $250 of expenditures for school supplies for their students. That was scheduled to be kicked out of the law at the end of this year. This extender left it in. So husband and wife still can get $250 deduction or $500, but you won't find it on the return. There's no place, no line to put it in. Instead, you put it on a line that says something entirely different, and you put a letter on it to identify that it is T for teacher, and that's how you get the deduction. Where's the brains here? Why did they have to wait until December to do this? Can't use a little bit of sense? And let's say there are no tax laws to be enacted after a given date. Either do it and get on with the show, or don't do it, for God's sakes. I mean, why make... So what will happen is the people who go to a professional who understand this will probably get a deduction. The people that use TurboTax will get... the people who use it, do it on their own will probably get nothing. But that's pretty typical of the tax law. Something else that is extended as well. For those of you who are as old as I am, you'll remember that we used to deduct sales taxes. Do you remember those good old days where you got a deduction for sales taxes, and some of you would keep all kinds of records so you knew what the sales taxes were? Well, last year for the first time, you had an option. You could either take a sales tax deduction, or you could deduct the state and local income taxes, whichever was higher. It was scheduled to go out. Here comes the extender. It's back in. Now, who does this really help? The people in Nevada, the people in Florida, the people in Tennessee. And by the way, do you know how many states have no income taxes? Throw me out a figure. You're right. Whoever said 9 is right. 9 states have no state income taxes. And that's where I'm moving pretty shortly. But anyway, that's not here, not there. But the bottom line is that those provisions are in there. And one other thing that's in there, and this is interesting for any students that are here. We had an education deduction, a college education deduction, where you could get a deduction up to $4,000 in some cases and $2,000 in other cases toward adjusted gross income. A straight deduction. That was scheduled to expire. It's back in the code. By the way, I just saw Emily raising her hand. The reason she was flagging me down was to remind you that if you have a question, there's a little card there in your packet. Write down the question. We'll try to get it answered. If I don't answer it today, guess what? I'll answer it on the air on Saturday. That'll make you listen. No, but I'll try to answer it on Saturday. So, fill those out and we'll go ahead and get those. Okay, now let's see here. What other things do we want to talk? Oh, what are some of the other things that are out there? And this is for everybody. I know you've heard a lot about this. I've talked about it for a long time, and you've heard about it recently. There used to be a federal telephone excise tax. It ran from February of 2003 through August of 2006. It was determined that was unlawful. Shouldn't have been there. These were long-distance calls only. So in this year, The government has provided a credit for every individual or for every couple as follows. If you just take the standard credit, if you're single, you get $30. If you have 2 people, it's $40, 3, $50, and 4 or more, you automatically get a $60 credit. Now, and that's automatic. Or you can take this option if you like it better. You can go to your telephone bills, and I know all of you have them at home. You store them and keep them. You can go to your telephone bills. You can add up the telephone excise, this is the federal telephone excise tax credit, and if you get more of a figure than the one I just mentioned, you get that credit. Take the information to your preparer, and I'm sure he'll know how to do it, and he'll get it done. I will tell you this, the IRS has come out with a memorandum. Americans are doing this completely wrong. And really, I'm telling you the truth now. This is on the website. You can go to irs.gov and see it. They are seeing a lot of credits being taken, and they know that they're wrong because the dollar amount is so high. One of them was like about $15,000. Probably went to H&R. No. But the bottom line, don't anybody say anything to Henry, will you, that I said that. But the bottom line is that they're taking excess credits which should not be taken. I will also tell you this. A lot of times we have taxpayers who don't even have to file income tax returns because their income isn't enough. For example, if we have somebody who's married and over the age of 65, both taxpayers, they don't even have to file a return if their adjusted gross or taxable income is under $18,000. It's not required. However, they are entitled to get the credit. So let's say you have a friend of yours, God forbid, at a nursing home or whatever, who doesn't have to file a return. If you flip over here, let me look at my exhibit number again. Here it is. If you flip over to exhibit, there it is, E. That is what's called the 1040 EZT. If you don't have to file a return, you simply fill this out, send it in, you'll get your money back. There's some people that will qualify for that. They don't have to file an income tax return. There's just one piece of paper here, and they'll get, their credit money back. So that's one of the good things. Oh, and one other good thing. 2 others, actually. What's the filing deadline this year, guys? 17th. Why is that? Emancipation Day. Right. The 15th falls on a weekend. Normally it would have been the 16th. And for those of you who are our clients, yeah, you procrastinators, yeah, y'all see on the 17th. But the bottom line is that you do, in fact, get a couple of extra days. Also, for those of you who are extenders, who love nothing better to extend your tax return, and you should never do that if you owe taxes, because what happens when you do, if you owe taxes, you're going to pay interest and penalties. But we have only one extension. No, not 2. You automatically now can go down to October the 15th and not file a return. But please be sure you pay the tax. So that extender is in there as well, and it's good if you're the kind of procrastinators like some of our clients. Okay, so that pretty well covers the items that are of major importance. I want to go for just a minute and talk a little bit now about some of the things that I think that are important in things like Social Security, Medicare, etc. Social Security is a nice thing. There's no doubt about it. And unfortunately, 23% of all Americans, that's their major source of income. Can you believe that? 23% of all Americans over the age of 65, actually over the full retirement age. Because, you don't get your benefits anymore until you reach full retirement age, which this year happens to be 65 plus 8 months or 10, depending upon when you were born. But I want to tell you some of the problems that we have with Social Security. A lot of people are not getting everything they should get. One of the most frequently asked questions I get on the air and from people I do seminars is, I'm 62. Should I start my withdrawal? Remember, if you're 62, you can start a withdrawal. And for the person who's 62 now, the chances are they're not going to get to draw until they're about 66 and a half when they do reach full retirement age. Generally speaking, not always, but generally, I tell my clients, take the Social Security at the earliest possible time. Unless you know for sure you're going to live another 19 years beyond the age of 65. If you know that for sure, then wait. But if you don't, then you're better off normally to take it when you reach 62. The other thing I want to mention is this, that let's say, as an example, the wife is 2 years younger than the husband. She starts drawing at the age of 62. The husband continues to work. He reaches his full retirement age at 65 and let's say, or say 66. It'll depend on when he was born. When he reaches age 66 and starts drawing his full retirement benefits, the first thing you want to do as the spouse is to call the Social Security Administration, because the likelihood is you may draw more than on your own record. For example, take the case of Bev and myself. I was smart. When I got married, I married a woman 7 years younger than I was. You know, I figured, well, I needed all the help I could get. And so I had already reached full retirement age. My wife was just getting around to being 60-some. Oh, by the way, she'll never talk to me since I disclosed her. Anybody got a room in their home tonight, by the way? I might need a bed. But the bottom line, she's laughing, I'm not. But anyway, the bottom line to this is that since I had already started drawing full benefits, she was entitled to get and work off of my work history. If she'd have gone on her own, she'd have gotten significantly lower benefits. But because I was already drawing benefits, she was entitled to at least half of my benefits, and depending upon the age she did it, even more. So any of you that have that situation, be sure you call the Social Security Administration. You probably are not getting all of your benefits. Now, I frequently told you in these meetings that there are other things that are important with respect to Social Security. For example, if you are a widow or a widower at the age of 60 and you're not married and you've had a deceased spouse, you could have been married 4 times. And if one of those had died, one of those spouses had died, you were then a widower or widower, you can start drawing at the age of 60. And how much do you get? 81%. 81% of that individual's decedent's benefits had he in fact had full retirement age. So you want to make sure that, because see, most people think you can't do it until you're 62. And the other thing I want to mention to you is the nice thing about Social Security is what? You pay income taxes on it now, don't you? Thank you, Congress. 1985 was D-Day. That was the year in which Congress finally decided, well, we need a little money. Let's get these poor guys out there that can hardly make a living or are having a hard time, and let's get some more. Let's rake a few more bucks in. So what happens? Initially, 50% of the Social Security benefits got taxed. Now, how much in taxes do you pay? Up to 85% of your Social Security benefits can be taxed. And by the way, I might mention one other thing to you. Be careful, because if you do things like cashing in, for example, treasuries, and you suddenly create more taxable income, more of your Social Security is going to get taxed. So don't run and do these kinds of things without checking with your preparer and finding out should you or should you not be cashing in your securities. One other thing I want to digress for just a second. As you probably know, U.S. Treasuries, the interest on it is not taxed at the state level. Shake your head and say, yes, you know it, or no, you don't. I just want to make sure you're still awake. That's the only reason. But it is important that you realize one thing. U.S. Treasuries have a whole bunch of different categories. For example, the Federal Home Loan Bank is a U.S. security. The Federal Home Credit is a U.S. securities. There's a list of 20 different securities that are, in fact, U.S. interest securities that you do not need to pay taxes on in the state. Okay, let's, one other thing I want to talk to you about. Flip over here to the front of the yellow pass-out material. Senior Citizen Alert. If you're on Medicare, you're paying a premium every month, aren't you, for your Medicare insurance. Last year you paid $88.50. This year you're paying $93.50. However, big however, in the prescription drug bill of 2002 there was a little provision in there. And that provision basically said that if you had a certain amount of income, you'd pay even more in Medicare premiums. You noticed I said the old rate was $88.50. It's now $93.50. It only went up $5. The year before, the Medicare premium was up about $11. Why did it only go up $5? Because some of your richer people are paying more for Medicare premiums. Look at that table there. Let's say in the year 2005, as an example, let's say in the year 2005, and we're looking at your 2005 tax return, that in the year 2005, as a married couple, your adjusted gross income, let's just say, was $300,000. And why was it $300,000? Because you sold some stock. Or maybe you sold some land or whatever, and you pushed yourself into that category of $300,000. Your Medicare premiums have increased not from the $93.50, they're now $124.40. If you made over $400,000, your Medicare premiums are now $161.40, and that's automatically deducted from your Social Security check. Now, what can you do to make a change in that amount that's being withheld? Let's say that year 2005 was an unusual year for you. Instead, this year, instead of making, say, $300,000, you're only going to make $90,000 because you had a gain or whatever the circumstances was. You should now be paying roughly $105 or so. You can make a change in that. You can get it corrected if you file the necessary form to do that with. And if you look on Exhibit D, there it is for you. It's called a request for reconsideration, so that you can get away from paying this high premium that you're going to pay. And by the way, if you think this is bad, wait until next year. You think $161.40 is bad? When you get your January check next year, you'll pass out, because it's going to be almost double that figure. That's what's happening. And by the way, frankly, I think that that's what should happen. I mean, that's just my opinion. You know, if the wealthy are wealthy and they're making good money, so let them pay a little bit more. It's not the end of the world. They're not going to die, neither will I. So, you know, go ahead and make the payment. You know, this is a fair, in my opinion anyway, that's a fair and equitable way to do those sort of things. So to me, that makes some sense. Okay, let's talk about a couple of other things. I see Emily's approaching. That means we only have an hour and a half left. Is that right?
You guys are here till what, 10, 11,
yeah, right,
12?
Right. No.
12.
Somebody said no
said
here.
12.
No,
Wow.
we'll let him go. Okay.
There you go.
Okay.
Well, stay in the light.
Stay in the light.
Stay in
Okay.
the
All right.
light.
She says I got to stay in the light.
And
Okay.
remember your green cards. Thank you.
By the way, I want to tell you about those green cards. Are those the ones that where they're evaluating this?
Mm-hmm.
Okay. Well, I do want to mention something to you about those green cards. If you fill that out correctly and make it real positive, that $50 bill that's attached on the back will automatically pop off. If it's a bad evaluation, I get the 50 back. So I just wanted you to know that. I want to spend a little time, and I can't cover all this. I can see that because I'm running out of time already. I want to talk a little bit about IRAs and Roths. I told you I was going to give you a pass out when you leave that tells you all you ever want to know, I think, about IRAs and Roths. But I want to explain in depth to you what this critical thing is all about. You know, the IRAs have been in the Internal Revenue Code for roughly 29 years. And by the way, what was the original amount of contribution to the IRA back 28, 29 years ago? It was $2,000. It stayed that way for about 25 years until they finally changed it. Currently, in the current year, meaning 06, If you are under the age of 50, you can do an IRA for up to $4,000. If you're over 50, you can do it up to $5,000. But let's define the difference here between an IRA and a Roth. In an IRA, it's a tax-deferred investment, meaning you put money away, it earns money. When you take it out, you're going to get taxed. At 70 and a half in an IRA, you must start what? The required minimum distributions. In a Roth, it's entirely different. And I'm a big believer in these Roth for a lot of different reasons. Here's how they work. There's no deduction, first of all. Your adjusted gross income on a joint return cannot exceed $160,000. On a single taxpayer's return, the adjusted gross income cannot exceed $100,000. You can be in a qualified plan with an employer. If your adjusted gross income is under those figures, you can do a Roth. You put a Roth in. Say for example, I put away $5,000 this year. And say the next year I put another 5, so I put 10 away. Let's say I need the money in the third year. Can I take the money out? Sure I can. I can take it out anytime I wish. Whether I'm 20 years of age, whether I'm 59 and a half or over, I can always go in and take my money back and pay zero tax. Always available to be taken out. The earnings, on the other hand, are a different story. The earnings must stay in the Roth if you're under 59 and a half until you reach 59 and a half. If you're over 59 and a half, those earnings must stay in the Roth for 5 years. But at the age of 70 and a half, no required minimum distributions. In fact, you can even continue to do Roths. Remember, at 70 and a half, you can no longer do an IRA. You're aware of that, I'm assuming, right? You can no longer do an IRA. But you can do a Roth, as long as there's earned income. Say, for example, I'm working, and I'm over 70 and a half. I could do a Roth for myself of $5,000, and if my wife is over 50 and a half, she doesn't have to be working. I can do the $5,000 for her, as long as my adjusted gross income on that return is under $160,000. So why does it not make sense to do a Roth? There isn't any reason that I can think of on God's green earth. If I have the money, isn't it better to make it work tax-free? Always have the principal available when I need it and want it for an emergency or otherwise. I can leave it to my kids if I wish to do so. They'll not pay any tax on that either. So it's a win-win situation. The only time I ever recommend an IRA, a deductible IRA, is if I got somebody who's in the 35% bracket. Then I'll do it. Because he's getting a great deduction, it probably makes sense to do it. But a lot has to factor in on what the age is. Now, what about converting this IRA to a Roth IRA? Does it make sense? A lot of things have to be considered. And I get this asked very frequently from my own clients, and I get calls on the air about it. Number one, age. If I've got somebody who's young, and I define that anybody under the age of 60, no, well, no, not quite. But I define that as anybody, say, younger than 50 as an example, or younger than 40. I'm probably going to suggest to them to do it because they've got a long time, don't they, to make this thing grow and work, and they can invest it in one of Norm's mutual fund suggestions. They can invest it anywhere they wish, and hopefully it'll grow. And if they want to, they can put it in seed. They can do anything they wish. As long as they don't touch those earnings, hey, that's money made in the bank, and I'm never going to pay tax on it. And especially when they're young, it makes sense to do that. But even as you get older, depending on tax bracket, when should you convert? Obviously, the best time to convert is when you have the lowest tax bracket, right? Because if you convert an IRA to a Roth, you're going to create a tax liability no matter when you do it. If it was a deductible IRA. If it's not, that's a whole nother story. Anybody here ever do non-deductibles? Have you started to withdraw your IRAs already? If you have, you're being faced with that wonderful Form 8606, which is a god-awful mess. It is. It's not simple. It's tough. It's not easy, and you basically have to learn how to do it. But right now, I'm recommending to you that you do these non-deductibles, because we will be able to convert them there in the year 2010, which is a significant change in the law. So age becomes important. Tax bracket becomes important. The amount you wish to convert becomes important. Watch out. Don't convert it all in 1 year, because you don't want to hit another higher tax bracket, do you? What's the top tax bracket? 35%. What's the lowest tax bracket? 10%. 0 is even a better bracket, but I don't consider that to be a bracket. But so take a look carefully. There is a right time for you to take your IRAs and convert it to a Roth. But you have to make that, you have to look at all these aspects, and I just mentioned 3 of them. There's actually about 10 different ones in the pass-out material that you'll get. It gives you a complete explanation of how and when to consider that. And what you should do before you do it is call your consultant or tax preparer and ask him for his advice. By the way, I have good news for you in that regard. Congress is seriously considering, and I think it's going to happen, that tax preparers will be regulated, just like doctors and lawyers and CPAs, so that not anybody can just simply hang out and shingle and say, gee, I'm a tax preparer. Because today everybody does it. And why does everybody do it? What software do they use? TurboTax. Wonderful software if you know the tax laws. If you know nothing about it, you're probably going to find you're going to be in trouble. We see that all the time, by the way. It's just like a person going to swim for the first time. If he hasn't had a stroke yet, he'll probably sink. And that's exactly what happens in those particular cases. Let's see here. How much time do I have? Oh, well, I still got an hour, so that's good. Okay. I want to talk a little bit about education, since we're in an educational facility. For years and years and years, I kept talking on the air about how bad the tax law was because it kept giving all these benefits to farmers, to the elderly, to all these other groups of people, but never, ever did they give a tax benefit for helping people through college. And what's our most important asset in this country, really, truly? Our kids. You know, if we don't have kids who can carry on, who can continue to make this country grow and to prosper, we will lose what we built up. And you may say we're already losing it, but that's another issue I'll leave to the politicians. But it is important that we do, in fact, instill, and we finally have, educational benefits. And I want to discuss just a few of those so that you get an idea of what you can do. First of all, let's talk about 529 plans. I've been talking about 529 plans. I first started talking about them in 1997. What are they? They're plans that are established by every state in the union, and depending upon which state you use, you can get a deduction in Missouri and Kansas. For example, if you use the 529 plan and you're a Missouri resident, you can go with the MOST program. How much deduction can you get? Each taxpayer can get up to $8,000. They could give you're not going to do that, but you could give up to $8,000 apiece. If you gave 16, you'd save yourself roughly $1,000 in state income taxes. Kansas is a little different, but this year had a major, major, major change. Anybody do any 529 plans in Kansas? Surely some of you did. What you do is you set up a plan for the benefit of, it can be anybody you wish. Doesn't even have to be your own kids. It can be mine, and if you'd like their Social Security number, I'd be glad to give it to you. But you can do it for the benefit of anybody you wish. Let's say in Kansas, and the deduction, by the way, that you get in Kansas, this is not a federal deduction, this is a Kansas deduction, is $3,000 per taxpayer, meaning me, per beneficiary. So, for example, I've got 2 kids. I could give each one of them $3,000, or I get a deduction of $6,000. My wife could do the same. If we put the money in, the money is not their money. They cannot touch it. I am the owner of that money. It earns in that 529 plan. It works tax-free. Now comes college. I get a call from my son. He says, I'm ready to go to college. I need the money. Which college are you going to? As long as he's going to college, I don't care. I can go in there and I can instruct a withdrawal, and only I can. He can't. He can't go to it and do anything. It's not his money. I'm in control. And I can say, I want you to pay to KU $15,000. The earnings never get taxed, never ever get taxed. Remember, you got a deduction for it, but the earnings never get taxed. It goes for the college, and that's great. I mean, that's exactly what should happen. And these 529 plans are now nationwide. When I first started talking about it, only 6 states in the Union had it back in 1997. And the real beauty of that is what has happened now in Kansas. Previous to this, in the state of Kansas, if you wanted to make a payment to the plan, it had to be the Kansas Learning Quest program. And there's only certain investments that can be done within that program, and maybe I don't like those investments. This year, you can go to any State of the Union's plans, any one you wish, and make the contribution. Guess what? You still get a deduction in the state of Kansas. Now, I tell my clients which plans I think are the best. You can check with your own financial planner or whoever as to what they think. Some financial planners don't feel it makes sense. I disagree, but that's part of life. We don't all agree on everything. I think it's a wonderful way to go to build up a college education. Rather than giving the kids presents for this and presents for that, why don't you build a college education fund? Now, I'm going to give you a website. There is one book. It's the best written in the country. It's called The Best Way to Save for College. It's written by Joe Hurley. Joe and I do seminars on this, and we do them throughout the country on 529 plans. He's definitely the pro in this. SavingForCollege.com. That's the website. This book runs about $20 or so. If you've got kids, grandkids going to college, and by the way, it doesn't have to just be a college. It can be any type of post-secondary educational situation. It does not have to be an accredited college to get the benefit of this particular program. So look at these 529 plans, which are now a permanent part of the code. I think you'll find them to be very, very well done. Okay, talk a couple of other things, and then we're going to call it quits, I guess. I want to talk a little bit about I want to talk for just a minute about your home. Would you agree probably that maybe your home is maybe your best investment? Anybody here ever lost money on their home? If you are, you're certainly the exception. There's no question about it. The beauty of homes is not only have you made an investment, who's helped you to buy it? Uncle Sam and the state, right? They're giving you a deduction for the interest. They're giving you a deduction for the taxes. And thanks to our friend Bill Clinton, we don't pay any tax on the gain, do we? We sell a home. We've lived in it for 2 years or more, or 2 out of the last 5 years. If you sell a home that you lived in for at least 2 years, husband and wife, the first $500,000 of gain does not get taxed. Not the selling price, the gain. Now, you had that home for 2 years, let's say. And you say, boy, this is not bad. I just sold the home. I'm just throwing out a figure, $50,000. By the way, to make $50,000 and pay no taxes on it, how much would you have to make making a salary or any other type of taxable income to keep 50? What do you have to make to keep 50? Throw me a figure. Well, 100 probably, maybe 80, somewhere in that area. So by keeping 50, you're never going to give it up. You don't even have to buy another home. You can do whatever you want. But your wise move probably is to go out and buy another home. And what do you do with that home? If you got a brave wife, you live in there how many years? 2 years. Sell it, do the same thing. I actually have 7 or 8 clients who do that about every 2 to 3 years. Actually, one of them had 4 homes in Hallbrook. 4 homes. Started out the first year, early on, at my suggestion, built a home, lived in the home about 2.5 years, sold it, made a good profit. I think the least, by the way, he ever made was around $110,000 to $115,000. The most he ever made was $275,000. Good salesman. But the bottom line is, his wife bears the pressure of having to pack and all that other stuff that goes with it. But it's a nice way to make money, and that's the beauty, by the way, of the tax law. The law says you can do this every 2 years. And that's why people who have a home, that it makes sense. Now, let me make one other comment here. I'm talking to a group of people who maybe this does not apply to, but I want to mention it just in case. Let's say like my parents, who in lifetime didn't have a lot of assets, but who did own a home. And let's say, as an example, they own this home, but they were basically running out of money, didn't have a lot left. And they had a choice, either downsize or get out and go down to another area and get completely out of owning a home and start renting. Now, I told you earlier, what's a home? A home is what? An investment, isn't it? Sure it is. It's an investment. Now, there is one way a person can go, and I don't recommend it for everybody, and I rarely recommend it, but it works very well. There is a thing called a reverse mortgage. And what is a reverse mortgage? Just like it says, it's the reverse of a mortgage. When you have a mortgage, what do? You make monthly payments, right? Well, if a person is over the age of 62 and has limited amount of debt, they can actually go in and borrow money against their home. They make no payment for their entire life. The money is taken when they die or when they sell the home. Now, interest does accrue, no question about that, but look at it this way. They had the right to stay in that home. They didn't have to move. They didn't have to sell. They simply took an investment, and they kept it. And by the way, the nice thing about this particular reverse mortgage is this. Before a person can take and get a reverse mortgage, he must consult with another professional besides the lender to make sure he fully, and that's part of the law. There must be a certification statement that the lender ultimately gets that somebody else has again explained to him these reverse mortgages. And I tell you this because I think in some cases you might find that beneficial. The first company that ever did that here in the country, the reverse mortgages, was James B. Nutter and Company, who's been in business about 55 years. They do a great job in that area of reverse mortgages. Okay, let's talk about a couple of other subjects. I want to talk about some other deductions that are out there that are good to be doing. Let's first look at donations. A lot of good donations that can be deducted, but there's a lot of things that people miss. For example, if you drive your car for charitable purposes, I bet Elaine probably and Norman probably have enough in this deduction to zero out their tax. But the bottom line is, if you drive and spend as much time as people do in doing charitable work, we can get a deduction for the automobile. Your time is worthless, according to Uncle Sam, so you get no deduction for that. But you can get 14 cents a mile for charitable prayer. It's not huge, but it's something. I keep telling Bev she ought to always write it down. She hasn't yet, but one of these days I'm going to force her to do it because I figure I'm going to get a deduction of about $14,000, give or take a little. But I really think that you ought to keep track because a lot of people do a lot of charitable work, and it makes sense to do that. Another thing that makes sense is to do this clothing and household goods, and I always tell my clients as well as you, I can pass this around. If you don't know what to deduct, how many of you know what to deduct in the way of charity? I mean, my clients all know. Back in 1989, a gentleman and I up in Omaha, he was the developer of it, decided, gee, accountants don't know what the values of clothing and household goods is. Let's develop something that gives us and shows a deduction. I want to pass this around. By the way, if you walk out of here with this, there's an alarm that goes up over there, so don't try it. When you're through with it, please give it back to us. You might pass that around. This is a simple, easy way. All it involves is making a contribution to a charity, making a good list of what you're giving, and then staple the receipt from Goodwill, Salvation Army, or whoever, and at the end of the period, you complete something like this to get you the deduction. So that's another way to, get a deduction for. And by the way, there's so many good things. And Norman, I'm sure, is familiar with this, as well as other people. There are things like charitable remainder trusts that are absolutely golden and make a lot of sense to do. There is, by the way, another good thing. At the end of the year, are we all looking for deductions? Do you normally spend a little time the last 2 days, hopefully last month of the year, figuring, what out there can I possibly deduct? And a lot of times at the end of the year, I find myself in this situation. I'm trying to do everything I can to reduce my tax, and I start making all my donations, et cetera, to try to reduce it. But sometimes you find yourself a little squeezed for cash. There's a nice, easy way out. If you have a charitable organization that accepts a credit card, and many of them are starting to do that, what do? Just charge it on your credit card. Why not? As long as it hits your credit card on or before December 31st, it's deductible, whether you pay it off in January, February, March, or April. Hopefully you pay it off in January so that you don't get the highway robbery rates of credit cards. But it's a nice, simple way to make sure that you are, in fact, getting your deduction. And by the way, this also works for businesses. Anybody here self-employed or have a business? Same situation happens at the end of the year. We always have the same problems. We want to get the most charitable deduction, or the main business deductions that we can. And that's a good way to do it, is by putting things on a credit card. Credit cards qualify for a deduction even for cash basis taxpayers. So you might look at that as a, and while we're on the subject of credit cards, because I always mention this, how many of you here are Kansans? Can I kind of see a raise of hands? When's your real estate taxes due if you're paying them yourself? December the 20th or May the 15th? On the 20th, what do? If you'll notice, for example, in Johnson County, it's different in different counties in Kansas, you can use a Discover card. If you put the charge on your Discover card, you'll get some rebate depending upon which cash card you're using. And you don't have to pay the tax until when? Next year? Whenever you want. So in effect, that end of the year squeeze that we all have can get delayed by doing just exactly that, by putting it onto a credit card and in effect deferring the payment until the following year. Okay, I want to talk a little bit about how we effectively use this issue of capital gains. I told you earlier how the capital gain rules work. But what happens if we don't do the capital gains right? We sell some stock. We have a gain. And by the way, one of the biggest headaches we have in this business, tax preparation, is I get somebody in. They've sold some stock. What's the cost? A few of my clients are shedding their... but it's all that. It's not just my clients, it's everybody. Nobody seems to know what the cost of what the stock cost them, or the basis, if you will, in mutual funds. And you look at it and say, well, what's the gain? It's a big project, and obviously, the lower the cost, the more you're going to pay on tax on the gain. Isn't that right? So keeping the good records is utterly critical and important. You got to do that, folks. As much of a pain as it is, you got to know cost. If you don't know cost, what do you show as cost? That's right. I mean, that's what you're supposed to show. I'm sure 99% of the people guess at it. Chances of being audited are probably slim to none, but nevertheless, it needs to be done correctly. Now let's look at the fairness of the tax law with respect to this. What happens when you get a gain? Always gets taxed, doesn't it? Always, always. Got a gain? What about a loss? What happened? I sold stock and I had a gain of 10, but my losses were 30. So I had a net loss of 20. What do I get to deduct? $3,000. How can Congress and how can we as Americans live with that scenario? I mean, is that unfair or what is? If you're going to tax me on my gain, hey guys, give me that loss. I had a loss. I can show you here. Here it is right on paper. You want to look at my bank account? I'm out $20,000. Where's my deduction? Inequitable, unfair, shouldn't be that way. It's been that way as long as I've been in the tax business, and it shouldn't be that way. There's nothing that's fair about it. Of course, I might also add there's nothing fair about the Internal Revenue Code. Let's be honest about that as well. But it shouldn't be that way. So the important thing is that you do good tax planning. You need to look and see, certainly in the month of October, November, where are we? By the way, for those of you who are involved with Adam Bold and others that are in mutual funds, have you gotten your 1099s for last year? Have you looked at those whopping capital gains and ordinary dividends? About 3 to 5 times what you thought. And what do you do on it when you get it? Besides pass out, I mean. You realize that you're going to have to pay tax on this. And where's the money to do it with? It's sitting in a mutual fund, isn't it? You sell that mutual fund, you got a gain, you pay the tax on that as well, don't you? So nothing wrong with that, but I'm just saying there is another way to go besides mutual funds, as you and I know them. Anybody listen to our radio program on Saturdays? We've been telling you about it for some time. They're now one of the most popular things that have come into mutual funds. And I strongly recommend that you look at them. They're called exchange-traded funds. Doesn't mean that that's the only thing that should be in your portfolio, because it isn't. But ETFs are just what I said. They're exchange-traded funds. They're traded on the major exchanges. And believe it or not, the index funds, which is a fund like the S&P 500 index or the 30 index or any number of other indexes that are there, are sometimes a reasonable way to look at investing. But if you look at exchange-traded funds, here's what you'll see. Number one, they are much more tax efficient than mutual funds generally. Now there's exceptions. There's exceptions to everything. You need to understand exchange-traded funds. Like I say, they're traded on the exchanges. There's about roughly 100 or so funds that are available. The fees are almost non-existent. There are some fees, but very, very low. You can go to somebody, for example, that I've had on the program with me a long time here, Rich Romey, who specializes in this. Take a look at this book, Strategic Index Investing. Very well written book, 300 pages, that discusses exchange-traded funds. Look at them. You'll find that they're not only tax efficient, low fees, and there's all kinds of good funds that are out there on exchange-traded funds. By the way, how are your mutual funds generally doing last year? Well, I can tell you how they were doing, unless you got involved with somebody that's an expert in it and you did it on your own. Probably through about, I'm going to say July or August, you were about break even with the game. Generally speaking, I'm talking about the averages now. When did you make your money? September, October, November, December. And we had a good year, by the way, when you factor in those last 4 months of the year. Currently, year to date, the Dow is up about roughly 2 to 3%. So we're at least moving, at least in the right direction. But the idea is to diversify your investments and also to let you look at these exchange-traded funds as a possibility. But the key again with these is that you make sure that you have good tax basis. By the way, I want to mention one other thing to you as well. You know, I happen to be a big believer in the consumption tax. You all know that if you've been listening to my program for at least 20 of the years that I've been on the air. I've always said, look at the consumption tax. Get a copy of this book. It was on the New York Times bestseller list for about 3.5 months. It's called The Fair Tax Book. You'll love reading this book. It sets forth in good, simple, understandable English what is wrong with what we're living with today as we speak. Very well done. Anybody know who Neil Bortz is? He happens to be on KMBZ now, but he's a nationally known talk host. And, of course, John Linder, who's also involved with this particular movement, the Fair Tax Movement. Okay, a couple of other things I want to talk about, and then we're going to let you go. By the way, on this discussion that we were having about capital gains, I told you earlier, and you know this, that if you sell something other than your own home, you're going to pay tax on the gain if there is a gain. Now, a lot of you are doing the right thing, not just investing in stocks and mutual funds, but are hopefully investing in what other good asset? Real estate. By the way, last year, as an example, you know what a REIT is, a real estate investment trust? The real estate, for example, Vanguard's real estate investment trust last year was up 34% in 1 year. Doesn't mean it'll be that way every year, but the key is that one of the best investments, without any question of doubt, is real estate. And a lot of people do investing in real estate. The headache they have is if I invest in, say, a rental property, and I bought it for $100,000. Say I've kept it for 15 years, I depreciated it, and now it has a basis of $50,000. I sell it for $150,000. How much tax am I going to pay? Well, I'm going to get taxed on $100,000 for sure, of which $50,000 is going to get taxed at 25%, and the other $50,000 is going to get taxed at 15%. The only way that makes sense to get out of taxes in investment real estate, whether it's rental property, residential, commercial, raw land, whatever it is to do 1031 exchanges. It's one of the last golden rules left in the Internal Revenue Code, which allows an individual to build up wealth in real estate. And the smart real estate investors use it time and time again. We can now do even what's called a reverse mortgage, the reverse 1031, and it's very efficient. Don't you ever sell rental property without first talking to your tax professional about 1031 exchanges. In fact, I'll show you how well it can work. Let's say, as an example, that I own a piece of real estate here in Kansas City that's rental. And Bev and I have decided that we want to move to Miami, Florida when we retire. And, of course, she knows I'm not retiring until 97 anyway, so I'll be at a few years. But we decide we're going to move to Miami. Here's what I could do. I could take that piece of rental property, sell it, take the proceeds, and invest it in a piece of real estate that I would ultimately like to live in. I move over there into my real estate in Miami, Florida. I had a gain of $100,000 when I sold this property. I paid no tax. If I occupy that piece of property after I've rented it for at least 2 years, and if I've lived in it for at least 2 years thereafter, how much tax will I pay on this? That amount of money right there. So there's so many good things in this whole area of tax strategies that can be done. And understand, we're not talking here about a few pennies. This is a lot better than the coupons that you women get at the grocery stores. You know, it's much, much more productive than that. And it really creates some unbelievably great wealth that can be accomplished by using real estate to build wealth. People seem to be afraid, some people seem to be afraid of debt. I frequently get calls and people who come in and say, look, I bought a home. I have debt on my home. I'm in a hurry to pay that off. After all, my rate is 5.5%. Why are you in a hurry to pay it off? Is there a reason it makes sense to pay it off? Absolutely none whatsoever. That 5.5% loan is probably costing you, after the tax benefits, around 3%, maybe 3.5%. You think you can do better with your money someplace? Sure. Let me ask you another question. If a person goes out and starts a business, he normally has to borrow money to get his business going. Why does he do it? Because he thinks with borrowing that money, he's going to be able to make a profit, doesn't he? That's why he does it. And he borrows the money, hopefully he does well, and so the borrowing made dollars and cents. The same thing is true of a home. If you go out and you buy a home and you have debt, as long as you have at least a 20% equity in the loan, you pay no private mortgage insurance. And that truly is a waste of money, PMI. But the bottom line is, you now have debt. Don't be in a big hurry to pay it off. There's no need to be in a big hurry. You know, you might want to think about whether it doesn't make sense to just make the minimum payments that are required. As rates go down, try to refi it into a lower rate if possible. But don't be in a hurry to pay that off. Now, there is an age at which it makes sense. If you retire and you get to the point where you can't afford to do investing or do a lot of risk-taking and you're not making anything, it may make sense. But even here, for example, Norman will tell you this, I'm sure, I'm sure he would prefer to take the money, invest it maybe in a mutual fund. That's great. I mean, that's the way you make money. And that's the objective of what we're trying to accomplish here, is to try to make the money so that we can build wealth, so when we do retire, we've got something to fall back on. And that doesn't always happen if we don't do that all-important planning. And by the way, one other thing I want to mention to you, and that is if you have kids or grandkids, you want to be sure that you encourage them to do what you should have been doing all along, and that's to do some investing. If you start a kid out, for example, you get kids or grandkids as an example who are, say, doing some yard work or doing some other work, and they have earned income. And let's say they make $1,000. Let's just say, as an example, that's what they make. Of course, they're going to spend it. That's the American way. But why not be smart? Why not, as grandparents or parents, say, okay, son, you've made $1,000. I'll tell you what I'll do. I'll match it. I'll put it in an IRA for you. What kind? A Roth. And let's invest it. Let's show these kids that there is a way to make money, something that our parents never showed us. You know, I always like to use the example, and you've heard me use it before. I can remember when my mother used to go over to Meadow Lake Shopping Center over there on State Line in 76 or thereabouts. And about every month she'd come home and she'd say, son, I just made a deposit. It probably wasn't more than $100 or so. And look at this beautiful watch I got. I thought it was great. You know, she got a watch and she also put money away. By the time she died, the money she had was not making anything, but she had a lot of watches and clocks in the closet. But that's about all she had, right? She never got the benefit of making that money really grow. And had she, in fact, taught me at an early age to do something like that, I probably could have learned from that. But she didn't, and that was the problem. We never really ever learned. I want to talk to you just a minute here about something else that's... I'm sorry, what was that comment? I missed the pun. I want to also tell you a little bit about life insurance. I also want to tell you for just a minute a little bit about life insurance and some things that you might be interested to know. And that is that a lot of times Americans carry life insurance, and 88% of the people, I see you're there, I'll cut down just a minute here. 88% of Americans never ever get any money from their life insurance policies. 88% of Americans who put money into life insurance never see a penny out of that life insurance, and they spent the money. Now, I want to tell you there's something interesting that's out there. And by the way, why don't they? Because they get tired of paying the premiums, or maybe they didn't buy whole life, which gave them the ability to pay some of the premiums. But people end up carrying a life insurance, and they finally come to the age of being older, and they say, I'd really like to spend my money somewhere else. And they drop the policy. And they made an investment, haven't they, in all those years that they were paying the premiums. Well, there's an interesting concept going on right now that you want to know about. There's a company called Life Insurance Buyers. They will buy life insurance policies from you if you're over the age of roughly 65 years of age or so. They'll buy your policy, even if it's a term policy. You got a renewable term policy? You want to get rid of it? You want to stop paying the premiums? They'll buy the policy, and you'd be surprised how much they'll pay you for that policy. It's become a whole big national trend for individuals who are sick. It also can happen if you're younger. And in that case, let's say you're, God forbid, 30, and maybe have some sort of terminal illness, cancer, God forbid, or something else. They'll buy the policy, meaning you don't have to die to get the benefit of the policy that you had. Or go another way. Say you work with somebody else in a business, and you've had a policy within that company, and you don't have a buy-sell agreement, and you're not going to use it to buy the business, and you decide, okay, I don't need the policy anymore, don't let it lapse. Take the policy with you, pay a few premiums, and sell the policy. And by the way, in most cases, you'll probably not even create taxable income. So those are things that might make some sense. And I'm throwing out a whole bunch of different scenarios here to give you some idea of some things that you can do. Do we have some questions? Or are we out of time?
I think we're out of time.
Oh my gosh.
Peter.
Well, okay. To be continued next week. No.
Thank you so much,
Well, thank
Peter.
you for coming. I do appreciate it. And I'm going to ask you to do me a favor and yourself a favor. Number one, pick up that pass out when you leave. Number two, if you have some time and you're not busy on Saturday mornings between 11 and 1, listen to us. We're on every Saturday on KMBZ 980 on the AM dial. The program is Moneyline, and I certainly appreciate you listening to us. I hope you've learned something. If you haven't, give us a call. We're always glad to answer a question of any kind that you may have. We won't even ask your name. You can use Mr. X if you like, or Mrs. Y if you wish. Thank you very much.
Thank you, Peter. Thanks to all of you for sharing your evening with us. I know that you're ready to go. Just a couple things. Your green cards, hand them to the ushers on your way out. There are 2 books in the lobby. Jim Stowers, Yes, You Can Achieve Financial Independence, $10. It's normally $25 in the bookstore. And a second one, which is the best book Norman read last year, by Tony DePardo. And that's available in the lobby for $15, normally $25 in the bookstore. So stop by the tables in the lobby, pick up those for gifts or for yourself, and thanks for coming. We'll see you next time.